All right, part 3 of chapter 2. We're going to start talking about what a trial balance is. So when we talk about a trial balance, think about this. What is a trial? It's a test of something, right? So when we think about that, we're going to be testing the balances of our accounts. What it does is going to list each account title and its amount from our ledger in the trial balance. If an account has a zero balance, you list it with a 0 in the normal balance column, or sometimes you might see it left out completely. We're going to compute the total of the debit balances and the total of the credit balances. This is going to verify that total debits equals total credits. That's what we want to see. The total of debit balances equals the total of credit balances for the trial balance. However, equality of these two totals does not mean that there's not any error. So just because they equal doesn't mean that everything's great. It's a good start, but it's not a guarantee. So here's what one looks like. So this is a trial balance that lists the accounts that we had for Fast Forward with their ending balances. So we're just listing each account and their balances in the appropriate columns. If it had a debit balance, we're listing in the debit side. If it had a credit balance, we're listing on the credit side. Then we're going to add those all up and get a total. Make sure that the total debits equal the total credits. Again, doesn't mean that everything's perfect, but it's at least a good start. If this is wrong, we got to go back and figure it out. So if it doesn't come out right, there are some things we can do. There's ways of searching for errors. So if it doesn't balance, we have to find that error and we have to correct it. So first thing we want to do is make sure that we've added the totals up and that they equal each other and we didn't make a math error. Then we want to verify the account balances have been brought over correctly from the ledger. Make sure that the balances we had in the T accounts match what we have in the trial balance. The other thing we can do is see whether a debit or a credit was put in the wrong side. So if you put a credit as a debit accidentally, that can be a mistake that's easy to do. Another one is you can recompute each account balance in the ledger to make sure that you added the balance correctly in the T account before you brought it over. Another is to verify that each journal entry is properly posted. And you can verify that each journal entry has the same amount of debits and credits. That's another way to do it. All right, so then once we have that trial balance, we have those ending balances, then we can prepare our financial statements. So the financial statements we're going to be doing are the income statement, the balance sheet, the statement of owner's equity, and the statement of cash flows. So as we saw in the last chapter, after the trial balance has been prepared, we begin preparing these financial statements. We're always going to start with the income statement because net income from the income statement goes into the statement of owner's equity. After the income statement, we prepare the statement of owner's equity because the ending balance of owner's equity appears on the balance sheet. Then we prepare our balance sheet, and then finally we prepare our statement of cash flows last. All right, so again, we've talked about our statements before. I'm not going to go into too much depth of them. The key is that we have the income statement is revenues minus expenses to give you net income. Statement of owner's equity shows you the changes in the capital account from the beginning to the end of time or in the equity. It's also going to factor in investments and withdrawals. When we look at the balance sheet, that's giving you a snapshot of the accounting equation, assets, liabilities, and equity at a specific point in time. And then the statement of cash flows is going to list the cash inflows and outflows for the period and show us the overall change in cash. Just again, looking at the formatting for the income statement, revenues minus expenses. You can see that if we have two revenues, we're going to list them on the left with a total on the right. Same thing with expenses. When we're listing them, we're going to list them on the left, total on the right, and then get our difference. For the difference is going to be our net income or our net loss. All right, fast forward state of owner's equity is the second part in this slide. And it shows the beginning balance of 0. Plus the owner investment of $30,000. We have $33.95 that came from this income statement. We had $200 worth of withdrawals, and that gives us an ending owner's equity balance of $33,195. So the beginning capital balance is rarely 0. It's only 0 when you start the business, and that's because you haven't put anything into the business yet. There's been no investments. All right, our balance sheet, again, the ending capital comes down into the balance sheet, so we need to do it in order. The balance sheet is going to give us our assets, our liabilities, and our equity. Just some presentation things to think about. Again, when we're doing this in Connect, it's going to do all this information for you, but just so you know, if you ever had to prepare it on paper, what you should be including. So the dollar signs are not used in journals and ledgers. They're going to appear in financial statements and other reports such as trial balances. We put dollar signs beside only the first and the last numbers in a column. When amounts are entered in the journal, the ledger, or the trial balance, commas are optional to indicate thousands, millions, and billions if you need it. Commas are always used in financial statements. Companies typically are going to round off to the nearest dollar, and they might round up to a higher level, but typically we're going to see that nearest dollar is what we're going to round to. We're not going to see too many dollars and cents. It doesn't mean that we're not going to see any, but we're not going to see them in most of our examples. All right, the last part of the chapter 2 is computing the debt ratio. So I said before we have a ratio in every chapter. This is the chapter 2 debt ratio, and it's going to be used to analyze financial conditions again. It's evaluating the level of the debt or the risk of the debt. So when we talk about that, borrowing money is risky, right? So the debt to assets ratio helps determine the level of debt risk. We determine a company's ability to pay its debts or its liabilities using this debt ratio. The debt ratio is equal to total liabilities divided by total assets. When we have a higher ratio, that's telling us that we have a higher probability that we may not be able to pay their debt in the future. So the higher the liabilities to assets, the more challenging it could be to pay those liabilities when they come due. So that could be considered as a higher credit risk. So this is one of the things that our lenders are going to be looking at, is the debt ratio. All right, here's an example of an actual calculation for Walmart, and it's showing you current year, 1 year ago, and 2 years ago, taking total liabilities divided by total assets and getting the debt ratio. So we can see that they are getting a higher ratio in this example, and then they give you the comparison of Walmart, showing you their trend. So again, we've talked about ratios before, and we have to make sure that we're watching to see that sometimes you may have one ratio and it might look alarming, but you can't analyze a company based on one ratio or 1 year. You need to look at several years or several ratios to really make a decision about the company. Okay, that brings us to the end of our chapter 2, and that means we have 3 parts to chapter 2 that you should be reviewing. Thank you.